I'm Greg Hunter. Welcome to USAWatchdog.com. We're this guest we haven't had on in a couple of years. He's a great guest. He wrote the best-selling book on how to buy gold and silver of the century. Right here, you can see it. He also is out with many very instructional videos. One of the first times I ever saw him, it was an instructional video. It just has a silver tongue, knows how to explain things. His latest video is The Hidden Secrets of Money, number 6, and I'm talking about Mike Maloney, an expert in gold and silver. Mike Maloney, thank you for joining us today on USAWatchdog.com.
Thanks for having me, Greg.
Well, I watched your video, and we're going to link to the video, The Hidden Secrets of Money, number 6, and it's very interesting about the demographics and about how we're going to have deflation first, then inflation, and then worse deflation, and then hyperinflation. With this video, which I'm way oversimplified. People should go on and look at it. But where are we right now? You were telling people, okay, here's where we are in the graph, and here's where are we? Because a lot of people are just having a hard time with the collapse and the ongoing fraud to prop it up. And where are we?
Well, I call it the roller coaster crash. And basically, I wrote this back in 2005 and 2006 when I first started my book. It's basically, I said that we'd have inflation, and we were having inflation of asset prices. From 2005 to 2007, real estate was like doubling. So asset prices, the stock market, were all going up. And then I said we'd have the threat of deflation, to which Bernanke would overreact and do a helicopter drop. And that was the crisis of 2008 and all those mortgage-backed securities going bad. And he did do the helicopter drop, and it was a lot more than I thought it would be. But QE 1, 2, and 3, and then that would reflate things, but it's artificial, and that boom can't last. And I said that would roll over, and then there would be a real deflation, a contraction of the currency supply, and that would take us down into a big dip. That would cause all of the central bankers around the planet to overreact and print us possibly into a hyperinflation. They will just print and print and print until deflation gives way. And the thing is, we started with 0.8 trillion of base money, and now we've got about 4.2 trillion of base money. And so they've created 4 times more base money than existed, base currency. The base currency are the paper dollars that are in your wallet or deposits that the commercial banks have at the Federal Reserve Bank, redeemable in paper dollars. So it's basically just a measurement of the paper dollars that exist. And that is the currency that is required for banks to be able to create more currency through fractional reserve lending. But if they're not lending, it doesn't matter how much the Fed creates. If it's not going out and circulating, it doesn't create inflation of retail prices if it's just sitting on banks' balance sheets. They created 400% more the last time. This time, it isn't going to be creating another 3.2 trillion or so, 3.5 trillion, to get us out of some big crash. They're going to have to do the same type of percentage to get the same results. And so you're talking about inflating base currency to the same size or larger than the M3 currency supply, the broadest measure. It's absolute insanity. And the problem is, once there's that much base currency out there, you don't need the government to continue printing the currency into oblivion. All you need is the people to go out and start borrowing again, and the banks can create, through fractional reserve lending, a hyperinflation. A hyperinflation also only requires loss of faith in the currency. If people start getting rid of currency as quick as they get it, then prices fall. Or prices rise.
I know on your thing, the big deflation that you had Harry Dunton, who I think is a brilliant guy. He's done a lot of great work with the demographics, and in your video, it brings up the fact about how many people are paying for the retirees, and it's going to be one of the first times in history where the group of people paying for the retirees, usually small, is about the same. So there's a lot of retirees out there. And that's brilliant work and great math and deduction. My question is this, and I don't know the answer, so I'm going to ask you. If the bonds are going to be no good, that's the debt destruction, and the bonds are paid in Federal Reserve notes, another piece of debt, Uh, can't the dollars just go poof? I mean, can't the currency just go away, not just hyperinflate, but completely go away in short order? I mean, if we default on the bonds, don't we default on the dollar?
Yes, basically we do. So that's the short answer to that. But if you look at the like the 30-year Treasury, if you go back all the way back to 1980, we've been in this perfect bull market of bonds now for 35 years, and no bull market lasts forever. We're due for another recession soon. The Federal Reserve is completely out of bullets. They created so much currency through the QE programs, and they've held interest rates at zero. There's still, the fact that interest rates are still at zero says that there's an emergency going on right now. But yes, dollars can vanish. But what people don't realize, if they watch episode 4 of Hidden Secrets of Money, they'll see the way that currency is created, the way the monetary system works. It's our most popular episode. It's got about 4.2 million views right now. And what it shows is that every dollar that exists was borrowed into existence, and we promised to pay that back plus interest. And it doesn't matter whether that dollar was created through the issuance of a bond that the Federal Reserve bought, or whether it was created by the banks doing fractional reserve lending. When you take out a loan, they create dollars, and you promise to pay back that loan with interest. The currency to pay the interest doesn't exist yet. And so we have to go deeper in debt every year as a society to stay even. So we typically go a little bit deeper in debt than we need to stay even, and that's one of the things that's sustaining growth. All it takes is for people to get scared and not roll over loans, to pay down their credit cards, to try and pay off their car or their mortgage debt, and the whole thing starts to go into a vicious Keynesian collapse. It's the reverse of fractional reserve lending and this.
Is that where we are on the curve? This down and this up, and we're ready for the big. We're right there, ready to roll over. Is that where we are? Are we getting ready to have some severe deflation, debt destruction, job losses, that kind of stuff? Stock market sell off.
They pumped the currency supply, and they pumped the economy so much with all the QE. It's unprecedented in history to create this much currency and have. They think they've had a positive outcome. They think they saved the world. But this creates energy that is stored. In the video, Harry Dent talks about messing with Mother Nature. The free market is basically Mother Nature. And when you artificially hold interest rates at zero, that creates stored up energy that the free market will someday overwhelm. When you create a whole bunch of currency, that creates stored up energy that the free market will someday overwhelm. And it looks to me as though the top is in for the stock market. I might be wrong, but we've since the August crash, we haven't been able to get past the previous highs, and the stock market just isn't looking that healthy. It got up near those highs, rolled over, and started to take a plunge. There's been a little bit of a rebound since, but it really doesn't look that good. And the fact that every 2 to 9 years there is a recession, and the average is about 4.5 or 5 years, we are already 7 years into this expansion. And so there is a recession due. And like I said, the Fed is completely out of bullets. So the second half of the economic storm that started in 2007 and crashed in 2008, and then we've been in the eye of the hurricane from 2009-10 until today. And the second half of this economic storm is about to start. I believe that in 2016 we're going to see something happen, and 2017 will probably be pretty bad for the general economy. And I think that, when I was writing my book, I also sort of tripped over the fact that every 30 to 40 years the world has an entirely new monetary system. We're going to, this monetary system that we're on right now, the global U.S. dollar standard, excuse me, is now 44 years old. It's the worst designed of all the monetary systems, and it's developing stress cracks very, very rapidly right now. There was a calm before the storm until Saddam Hussein tried to sell oil in euros. And now one country after another is trying to bypass or not use the global dollar standard entirely. And now, the IMF is considering the Chinese yuan as a reserve currency to back the SDRs that they create, their own fiat currency. That is just another nail in the coffin of the global dollar standard. If we have a currency crisis, a recession, and this change in monetary system all together, this is going to be absolute chaos. And I do believe that we've got this deflation coming just because of all the demographics and the completion of all these cycles. So I urge people to watch this new episode, the 6th episode of Hidden Secrets of Money, the roller coaster crash. I think it's inevitable. I can't identify any time in history where a nation of debtors and spenders goes directly into big inflation or hyperinflation, because that rewards the masses for mass stupidity. There is no, we don't, for 30 years now, 35 years, the Federal Reserve has punished savers and rewarded spenders and speculators through artificially low interest rates, trying to goose the economy by keeping them just slightly below what the free market would be setting them at. And that causes people to use their homes like ATMs, to not have any savings. And now we got this big baby boom demographic that's going to want to retire soon, and they think that the government is going to take care of them. The government just doesn't have the funds to be able to take care of everybody.
Are we going to have a real estate bust bigger than the last bust? I mean, is housing going to get cut in half or cut by 90% or something like? What's going to happen with housing? What's this going to look like, the next leg, the deflationary leg, the big deflation that you say is coming? What's it going to look like to the guy on the street?
Well, when people retire, they're empty nesters. This is where the baby boom generation is right now. Their kids are moving out and going to college and things like that. So they've got a 4-bedroom, 3-bathroom home that they don't need. They tend to sell those things and downsize. They want to move to a home on the golf course or something, a 1-bedroom or 2-bedroom condo. But also, one thing Harry pointed out in this interview, Harry Dent, is that when people die, they are sellers. They are not buyers of homes. And if you've got this larger population of older people than the younger generation coming up behind them to buy homes, it means there's going to be a surplus of homes. But we're going into what I call the Bernanke bust. The 2008 global financial crisis was of Alan Greenspan's making. Ben Bernanke just reacted to it. But it was caused because of Alan Greenspan's overreaction to the crash of the NASDAQ. So we had a crash of the stock market in 2000. Alan Greenspan overreacted, held interest rates down too long to try and get the stock market reflated, to get it back up. And what he did was he accidentally created a real estate bubble. And the next crash was both stocks and real estate. This time it's stocks, real estate, and bonds. So this is going to be the biggest crash in history. This bond market bubble is something that has been continually inflated for the past 35 years, and when it pops, it's going to be devastating. And a bond bubble bursting is deflationary.
Janet Yellen, the Fed, they look absolutely crazy, schizophrenic. I said it on one of my newscasts. I think I said it last week. They look schizophrenic. They look wackadoodle. They look, you got one Fed governor saying the economy's great. You got Yellen saying we may have negative interest rates. What do you think they're going to do, and what do you think's going on behind the scenes?
Well, what I think they're going to do is, like I said, they're pretty much out of bullets when it comes to interest rates. So the only option that they've got is to create currency. And there's a difference between base money and the rest of the currency supply. Base money is the portion of the currency supply that the Federal Reserve creates when they buy something. They write a check on an account that has nothing in it, and when they write that check, currency is created. Dollars are created. And so it was a very small portion of the currency supply, just a few percent. And then after the crisis of '08, it's about $4 trillion out of an $18 trillion currency supply now. Instead of .8, it's about $4 trillion. And the only option that they've got, the only thing they can do is create currency. And history shows that this doesn't work. It just leads to a loss of faith in the currency. But one of the things that I discovered that I just put, if you look at the last few pages of my book, you'll see that I discovered what I call the financialization of government. Government, it used to be that, except for the Great Depression, where the stock market dropped 90% and the GDP shrank by 1/3, government income was not necessarily reliant on the stock market doing well. It was just reliant on GDP and most people's W-2 income, the working wages that people get. That's where the government income came from. But in this century, what I've discovered when I did some analysis is that the income for the government is highly reliant on how well the stock market does now. So for the first time since the Great Depression, with the crash of the NASDAQ, government income fell dramatically. Then with the crash of the real estate bubble in 2007 and 8 and the stock market, the income, I believe government income fell by 28%. And, if you go back to like the crash of 1987, government income just went flat for a year. So my point is, we've got this government that is like this monster that just keeps on growing, and you've got to feed it. And when the stock market, when we have the next crash, the government has to get us out of that so that its own survival is at stake. And so they will try to print until this deflation gives way. And that's going to be disastrous. It hasn't worked for Japan. It hasn't worked for anybody. And it's not going to work this time. But if you have all of the world's central banks doing this in unison, eventually the deflation will turn around and it'll turn into a big inflation or hyperinflation.
And you don't think the Fed's going to raise interest rates? I mean, if they did that, it'd be game, set, match, wouldn't it?
Right. If they did that, they're going to cause the next crash, the next crisis. If they don't, they just prolong the eye of the storm just a little bit longer. But people are losing faith because they've been making all this noise about raising rates, and they haven't. The fact that they haven't, that they won't let the free market set interest rates, that they won't let them rise at all, shows that they are goosing the economy because they know that there is still an emergency going on.
Ha! They don't want to let it fall yet. So
Right.
You're saying they're not going to raise rates before Christmas? No way.
No. Well, I don't think they're going to raise rates at all. But if they do, what will happen is even if it's just 25 basis points, a 0.25%, it would crash the economy.
Now, you've had Harry Dent on, and I got to tell you, he's been right since 2011. Or I think 12, he started saying gold's going to take a hit, and it sure did. So I got to give Harry Dent some credit.
Actually,
A lot of people
he started saying that long before that.
He was saying that before that.
Yeah.
He's a smart guy. There's no doubt about it. But you're a guy that believes in gold and silver. Harry Dent doesn't think that gold and silver will go up for a couple of decades or something. You can't think that, do you? I mean, where does gold and silver fit in, and what do you think is going to happen near term and longer term?
Well, that's the one area, if you watch the bonus presentation, there's a bonus presentation where we talk about the types of investments that are going to do well in what's coming. And in there, we agree to disagree when it comes to gold. In the last great deflation, the only big deflation that we can point to that is well studied, which was the Great Depression, gold rose 70%, and the dollar's purchasing power, the currency supply contracted by 1/3. So the dollar's purchasing power went up by the inverse of that. If you owned gold, you ended up with about 2.5 times the purchasing power because gold rose in price and each dollar purchased more goods. So one of the few assets that actually did well in the last great deflation was gold. So that's where I am at. I do believe...
Well, you can't destroy it. The bonds can be destroyed.
Exactly.
We're going to find out that that debt is not money, as I've been saying this for I don't know how long.
Yes.
Debt is not money, and debt is not an asset. We're going to find out that both those are, they've been told that debt is money and debt is an asset. We're going to find out neither is true. Would you agree with that?
Correct. If you watch the first episode of Hidden Secrets of Money, it's about the difference between money and currency. All of our currency is debt-based. It is not money. And, I consider it like it's your job also to enlighten the world. The mission of Hidden Secrets of Money is to enlighten the world that maximum prosperity can only be achieved through individual freedom, free markets, and sound money. And there's a big difference between money and currency. Currency has to be a medium of exchange, a unit of account. It's got to be portable, durable, divisible, something called fungible, which means that units are interchangeable. If I loan you a $20 bill, you can pay me back with 5 ones, a 5, and a 10, and I don't care. Money has to be all of those things plus a store of value. And the dollar has dropped 96% since the inception of the Federal Reserve. It is not a store of value. If it was a store of value, there would be no such thing as inflation. Prices would not rise. We have to start enlightening the world that we do not use money, and that is one of the biggest sources of all of these crises, these problems that we have, these setbacks. Our prosperity today would be so much greater, I feel, if we had been using honest money instead of national currencies that are debt fiat currencies.
And people like I hate to go back to Harry Dent, but he's in your video, and I like him. I think he's a smart guy, but he has said that gold's going to go down to $200 or $300 an ounce. Do you agree with that?
Well, Robert Prechter, when I started buying gold at about 325, and I've been buying gold ever since. I'm preparing for the currency crisis. In a currency crisis, gold is not going to stay down. If it went down to 250, I would take that opportunity to buy as much as possible.
Do you think it'll go down from here, from the the 1100, 1080 range, whatever? Do you think it's going to go down to like what he says, or do you think it's people Charles Nenner, the great cycle guy, Wall Street analyst, says we're about the low right now? What do you say? What say you?
I think it's possible that spot price on gold could go down to maybe 700. But what happens when the spot price goes too low is you develop shortages of physical, and the spread between the spot price and the physical grows. Like, for instance, we just had a silver shortage for just a few months, and silver dropped in price by $2. The spot price of the IOUs on the commodities exchange, the futures contracts, paper silver went down $2. Silver Eagles didn't go down at all. There were some periods of time where they were actually higher. The price that we pay for Silver Eagles as a dealer to get them doubled, a little bit more than double. So the premium over spot expanded. And so what you're going to see is if gold drops to 700, you're still going to be paying $1,000 or more to get physical gold that you can hold in your hand, because there will be a huge rush toward it. The spot price right now is actually too low for what the free market would set it at if we didn't have 300 to 1 leverage on the commodities exchange. If you look at the gold in the registered category, I don't know what it is today, but last week it was 298 futures contracts or ounces of futures contracts for each ounce of gold that actually exists that was deliverable into those futures contracts. In other words, there were 298 people that thought that they could lay claim to the same ounce of gold. This is just like fractional reserve banking on the commodities exchange, and it's a disaster waiting to happen. And if there is a force majeure on the commodities exchange, the only remedy to that is for gold's price to rise high enough to get enough people to move their gold from the eligible category into the registered category so that enough is available for delivery into futures contracts. So we're seeing a set of, like gold being in backwardation for so long, we're seeing a set of very unusual circumstances right now that suggests to me that even if the price, the spot price went down, there's going to be a mad rush toward gold and silver again. It's probably coming within the next year or so. I do believe that you could see the spot price break 1,000. I might be wrong. Nenner might be right that we're at the bottom right now and that it's going to go up from here. But Robert Prechter Since gold was hitting 300-400 an ounce, he's been saying don't buy it. It's going back to 250. Well, it went to 1900. So anybody that was following Robert Prechter didn't go along for that ride. Harry Dent has been saying that gold is going down for quite a number of years. Harry is right about a lot of things, but we just agree to disagree about gold. That's one of the few things where we don't quite see eye to eye. Gold is not just a commodity. Gold is a commodity and money. That's the difference. In a currency crisis, people are going to be rushing back toward gold. And it doesn't matter whether the currency crisis is deflationary or inflationary. In the last great deflation, gold's purchasing power went up about 2.5 times.
Oh, well, and I just had Warren Pollock on, who's a big thinking Wall Street analyst, geopolitical guy, and he says, well, it could be even worse than that. I mean, if we have war, and I wanted to just end with this about, France is calling up over 100,000 troops. They have been on a terror bombing missions over in Syria for ISIS. They want a coalition. France, the headline today in the Post-Dispatch and some of the other papers, St. Louis Post-Dispatch, they want a coalition. I mean, when have you ever heard France wanting to go to war? And how does this affect your investment horizon for precious metals in gold, silver, and the like? What do you think about that?
Gold does really well when there is gold. A lot of people think that gold is an inflation hedge, and it is not an inflation hedge. It's a crisis hedge. Gold is the safe haven asset. So is silver. And during war, terrorism, natural disaster, these things rise. France calling for a coalition and going to war. This is a very rare event for France to be doing that, but it just shows you the overreaction by politicians. This is all a creation, it's blowback from the West meddling in other people's business. If the United States would just get back to our own Constitution, one of the things that we were committed to at the beginning of this country was commerce with everyone, alliance with none. Commerce with all, alliance with none. So we're not supposed to be making alliances and taking sides. This is something, it could lead to something very, very bad. The Middle East is really a powder keg. There's a whole lot of fuses being lit right now. And that would actually bode very well for gold in the long run. However, when anxiety increases, the velocity of currency, the amount of times that people make transactions, slows down in an economy, and that is a very deflationary thing in and of itself. That doesn't require deflation and inflation of asset prices don't require an expansion or contraction of the currency supply in the short run. In the long run, it's all how much currency exists. But in the short run, it's the velocity of currency, how quickly it's changing hands, that determines whether prices are rising or falling. And when war starts, a lot of times there is anxiety, and that causes a short-term deflation that could go right along with all of these cycles that I point out in our episode 6 of Hidden Secrets of Money.
You can find the Hidden Secrets of Money at your fine website, goldsilver.com. Mike Maloney, also the book. Let me hold it up here. It is The Guide to Investing in Gold and Silver. It's one of the best-selling books about this topic in the last 100 years, according to Mike Maloney. Mike Maloney, thank you for joining us. Go ahead.
It's the best-selling book in this century.
Oh, in this century. Sorry. I'm sorry. It's the best-selling book in this century. It's a good book. A Guide to Investing in Gold and Silver. Mike Maloney, goldsilver.com. Thank you for joining us today on USAWatchdog.com.
Thank you very much, Greg. I want to urge everybody to pass this episode along also. Share it with your friends, simply because it's time to get prepared. Thank you.
Thank you for joining us, Mike Maloney, goldsilver.com.
See you next time.